Korean.
Good morning.
Pleasure meeting you.
Yep.
All right, I think it's time to roll this morning. Good morning. I am calling the regular meeting of the Equity Public-Private Committee to order today being Wednesday, July 13th, 8 a.m. Madam Secretary, do we have a quorum?
Yes, we do.
Okay, so at this point, I'm going to turn it over to you for instructions and roll call, please.
Thank you, Mr. Santos. This meeting is being conducted as a virtual meeting, so we'll do a roll call of the trustees to confirm attendance. Mr. Santos?
Present.
Mr. Knox?
Good morning, I'm here.
Thank you. Ms. Greenwood? Mr. Jones?
Good morning, present.
Thank you. Mr. Green? Okay, staff participating in the meeting include the following: CIO John Grable, CEO Santos Cramen, Chief Counsel Stephen Rice, and investment staff Chris Wagner. Consultants include the Makita team, Natalie Walker and Dan Kerkorian, presenting from the Makita Stepstone Group. Trustees, please use the Zoom chat option to be placed in the queue. At this time, we ask all meeting participants to mute their mics until you're ready to speak. And now we may proceed with the agenda.
Great, thank you very much. Good morning, everyone. Good to see all of you here today. The second item on the agenda is approval of the minutes for April 13.
I'll move approval.
Second.
It has been moved and duly second. Any amendments, comments?
Well, actually, I think they might have made the correction. Let me make sure I had it in my notes. There was a, was that the, that's for the Board of Investment meeting. There was a transposed date for the 13th for the 8th in there. So never mind.
The BOI, okay, good. Any other comments or proposed amendments? Hearing none, a roll call, please.
Mr. Santos?
Yes.
Mr. Knox?
Aye.
Mr. Jones?
Aye.
Okay, the motion passes unanimously.
Thank you. Next item is public comment. Have you received any requests for anyone to address the board?
We have not.
Great, hearing none. We're moving forward. Consent items, subsection 4A. That's consent item. I will entertain a motion unless there's a comment or question regarding that item.
Move approval.
Second.
It's been moved and duly second. Roll call.
Mr. Santos?
Yes.
Mr. Knox?
Aye.
Mr. Jones?
Aye.
Okay, the motion passes unanimously.
Great, thank you very much. Moving forward to item 5, reports, and that will be the private equity report. Mr. Wagner, Mr. Walker, and Mr. Kerkorian. Mr. Wagner.
Yep. Thank you, Mr. Chair, and good morning, committee members and other trustees attending the meeting. Today, Natalie Walker and Dan Kerkorian will provide an update on the private equity portfolio performance. I know Natalie introduced Dan a little bit earlier, but for those that weren't on, Dan works pretty much on the LACERA portfolio full time. He's been a member of the team for a number of years and is very value add. So I'm sure he'll have good things to say today. But before they get started, I just want to point out a couple of things. On the cover memo, we highlighted some of the good things that have happened to the portfolio over the past year and over the past 10 years, I guess. Performance has been consistent. The 10-year return has been good. Hopefully helping the trust get to its 7% actuarial rate. But we all know these numbers are in the rearview mirror. We have a lot of work to do now. Every morning when we wake up and open the newspapers or any news sources, you see inflation is getting higher. There's been a big time global correction to the public equity markets, and there's plenty of geopolitical uncertainty. So Natalie and Dan will cover not only the performance of the portfolio and what's gone on with it, but also what's happened in the first quarter of this year. So they'll be happy to entertain any questions during the presentation. We've allocated the full committee meeting to the presentation, so please don't hesitate to interrupt and ask questions. So I'll turn it over to Natalie and Dan now. If Kwok, thank you for driving the slides. You could go to the first slide of the review. Go ahead, Natalie.
Before we go forward, Ms. Walker, where's Mr. Fernandez? He's just not available today.
Mr. Fernandez, yeah, as out of the office with his family, unfortunately couldn't be here today, but sends his best.
Great, thank you very much. Do the same on my behalf.
I will.
The floor is yours, Ms. Walker.
Great, thank you. Yes, good morning, everyone. Great to see everyone, hopefully in person soon. So as Chris mentioned, we'll be providing an update on LACERA's private equity program today. And just a reminder, as a result of kind of the lag in private equity and private markets performance reporting, we thought it would be helpful to weave in, updates through the first quarter and even to today. To start, I'll provide kind of a general market overview through the first quarter of the year. And then I'll turn it over to Dan to provide an update on LACERA's performance through year end 2021. But again, Jose, myself, Dan really have been kind of the private equity team working side by side with your private equity professionals and have really enjoyed the relationship over the years. So maybe Kwok on slide 1. We can start here. So you can see on slide 1 the quarterly private equity returns by strategy for the last 4 quarters. So while Q4 of 2021 and this first quarter of 2022 couldn't have felt really more different, the chart shows that the quarter over quarter returns started to soften before this year and were really flat to slightly negative overall for the first quarter of this year. You can see the quarterly returns by strategy, buyout, venture capital, growth equity, other, and then the far right total private equity returns down about 1%. So just quickly kind of on, comparing and contrasting Q4 to Q1 of this year, obviously US and Euro equities made strong gains during the fourth quarter, with the S&P hitting a high level at the end of the year as economic resilience was really offset the concerns over the Omicron variant. But that said, private equity returns for Q4 continue to kind of trend downward compared to prior periods. You can see the total private equity performance on the right in the green bar at 5.6%. For Q4 compared to kind of higher returns for the prior 2 quarters. Venture capital, interestingly, generated the best quarterly returns of around 7% during Q4, but still performed poorly compared to its average of 14% during the prior 3 quarters. It's really no secret that Q1 was a very different story. Globally, investors endured an extremely volatile first quarter of 2022, and equity markets ended down across the board, obviously impacted primarily by the Russian invasion of Ukraine, but also, as we saw kind of on the private equity side, supply chain disruptions and worsening inflation, which, new news came out today regarding the second quarter of the year. While negative, domestic equities outperformed international markets during the quarter, and private equity returns specifically for Q1 followed suit, ended down during the quarter at -1%. Venture capital funds, just kind of comparing and contrasting to the end of last year, generated the largest quarterly loss at -4% during the quarter. And that was really kind of offset by the strategy's strong performance during the prior 3 quarters. Part of the rationale for buyouts being flat, compared to venture capital and growth equity, is just portfolio company fundamentals, at least as of Q1, were not soft despite public market valuations being down. In addition, VC saw less meaningful declines given the robust fundraising environment over the last couple years. And growth equity, as you might suspect, is highly concentrated in technology companies, so more likely to use public comps in their valuations. High growth technology stocks were hit the hardest, with most valuations reverting to the long-term mean. And we think that will bleed into, marks in the coming quarters. Really don't feel like we're at the bottom here on this chart. Expect, Q2, even Q3 valuations to potentially come in lower, depending on public markets and just the general macro environment. It does feel, from a private equity sense, like most companies, even lower growth ones, have runway to weather the short-term market volatility. Our venture capital and growth equity team tracks cash balances at underlying portfolio companies, and most VC and growth equity companies we're tracking, even kind of more subpar ones, were able to raise capital over the last couple years and have a couple years of cash runway. Still, if you've read the headlines, companies have been much quicker to act in playing defense than in past recessions. We also saw this in the first half of 2022 amidst COVID fears. Turning to buyouts specifically, about most of the transactions today, approximately 96% are covenant light. Over the last 10 years, covenant light deals have kind of ranged between 75 and 95% of transactions. And that really is compared to kind of only 30 to 35% covenant light deals leading up to the financial crisis. So essentially what that means for private equity is it take a lot longer to see any distressed buying opportunities or market dislocations for private equity, which would be captured through your special situations allocation. Slide 2, please.
Ms. Walker, before we move forward, now a lot of the experts, including your firm, have been predicting for the past several years that there was going to be a contraction in private equity, that we would not that we were spoiled in the past several years with the great returns, and everybody was predicting that's not going to happen, or the market is going to go down. So how much of all this is reflective of that prediction that private equity returns were not going to be as great as they have been in the past, and how much of that is the current environment with the pandemic and the war in Ukraine? Can you quantify that or not?
I think it's a combination of those two factors. Obviously, I think the war in Ukraine was harder to predict. Obviously, COVID hard to predict, but generally private equity weathered the COVID storm quite well. As we head into kind of this next period of recessionary pressure, I think that is what we've been underwriting to in a lot of our investments. So if you look at just kind of the valuations that we've endured over the last few years, they've been at peak valuations across industries, not just technology. If you look at where we are today, obviously technology has been hit the hardest, but valuations have come down, particularly in the publics, and we expect that to kind of bleed into the private equity market as well. So net generally creating better buying environment, but I think when you talk about the existing portfolio and what we've been underwriting to, it's lower leverage, lower valuations, and I think that will kind of help the portfolio kind of endure this next period.
That's great news, because the valuations have been very high for the past several years. So good. Let's see what happens. It's a buying opportunity.
Exactly. That would be the silver lining for sure.
Great. Thank you.
Of course. So just on page 2, on the fundraising and investment activity front, wanted to say a couple words. So Again, both have slowed compared to the 2021 highs that we witnessed. We think this is a positive trend, just given the rapid deployment pace experienced over the last couple of years, with funds coming back to market earlier and earlier, some within 12 to 18 months of their last fundraise. Global private equity fundraising totaled about $246 billion in the first quarter. That represents a decrease of about 13% quarter over quarter, but interestingly, a 19% increase compared to the first quarter of 2021. Wouldn't read too much into these numbers. I think remains to be seen the fundraising pace for the rest of the year, but we do expect it to be kind of down compared to 2021 and most recent kind of historic highs. The funds that were raised, as you can see in the chart on page 2, were really concentrated in the US, about 70%. That's higher than kind of the long-term 10-year average. And really the balance of capital coming from fundraising in Europe being down. So not surprisingly, given the situation in Ukraine. Buyout fundraising represented the majority of capital raised, with close to 60% of the total amount raised for the first quarter. That's about $138 billion and represents about a 25% decrease from Q4 of last year.
Ms. Walker, excuse me.
Yeah.
We have a question, Mr. Knox.
Oh, yeah, thank you. Sorry to interrupt, Ms. Walker, if you were in the middle of a point there. I think I saw this morning that the euro is now on par with the US dollar for the first time in 20 years. How does that impact fundraising and the movement of funds and the value of the US dollar compared?
So, most private equity funds, and particularly funds that LACERA is invested in, are denominated in US dollars. There are, select international, particularly European funds that we invest in that are based in euro. Over time, what we've seen with currency fluctuations is that, the ups and downs kind of net even out over a long period of time. So you're talking about, 10-year investment periods and managers that you're re-upping with every kind of 3 to 5 years. So we expect kind of currency over time to be net neutral, but certainly can have short-term impacts when the US dollar and euro are at parity. I do think it makes it a little bit easier in the current environment to assess kind of returns when the US dollar and the euro are at parity.
Interesting. Okay, thank you.
Just to follow up on that, Ms. Walker. So the appreciation of the US dollar is wonderful for us, the buyers, but at the same time is the emerging markets and pretty much all other currencies are taking a beating as a consequence of the US dollar value. And so it's a negative for us in terms of the returns around the world. Wouldn't that be, Ms. Walker?
That is correct, particularly from a short-term perspective. And I think, Mr. Santos, you and I have a soft spot for investments in Latin America in addition to US buyout. I also sit on our Latin America team, and I think the unfortunate thing with currency fluctuations is that when those returns deteriorate, it makes it harder to make the argument to invest in some of those economies, and investors tend to flee. That being said, when capital retracts from a region, it does create a good buying opportunity. So the hope is that investors see that opportunity and don't kind of retrench 100%.
Great, thank you.
So just, back to the chart on page 2, venture capital raised about $90 billion for the first quarter. That's actually a 30% increase quarter over quarter. We do expect that to definitely come down and venture capital fundraising to soften off of kind of market volatility, particularly in tech. In terms of deal count, Q1 was down about 25% in the first quarter of 2021, or compared to the first quarter of 2021. We do expect kind of for the first half of the year for deal activity to be down about 20%. On slide 3, you can see that the volatile public markets in the first quarter obviously probably had the most significant impact on the number of IPOs. So private equity backed IPOs, which have been on kind of a run starting really in 2019 and reaching its peak in 2021, as you can see in the chart, were significantly impacted in the first quarter. Private equity IPOs decreased significantly with only $1 billion raised by 8 IPOs. This compares to $27 billion raised by 46 IPOs in the fourth quarter. The largest IPO of the fourth quarter was completed by Rivian, which raised $14 billion and one of the largest IPOs ever, and was about half of the total value for all IPOs during the quarter. So do expect IPOs to continue to trend downwards. In addition, just the last point I'll make on this slide is SPAC issuance, which had been kind of a recent trend in private markets, also fell significantly in the first quarter of 2022. Really 91 SPACs raising $11 billion compared to $35 billion being raised by over 200 SPACs during the fourth quarter. So significant change that we expect to continue into the rest of the year. And then just last, in terms of market commentary on slide 4.
Mr. Chair, could I ask a quick question again?
Absolutely, yes, sir.
Related to SPACs, is your sense that that was a fad, a trend that we're just not ever going to see again? Or is that just kind of similar to the IPO activities where they're just kind of biding their time and we'll see more of it again in the future? My sense was it was more of the fad trend. And
I think so. I think it was certainly private investors taking advantage of strong public markets as a way to raise capital. So if that opportunity comes back, you could see SPAC issuance rise.
Okay, thank you.
And then on slide 4, you can see that the number of private equity backed mergers and acquisitions, or M&A, fell in Q1. This 630 private equity backed deals in Q1 and 290 billion. That compares to about 900 private equity M&A deals and 330 billion. So more significant in terms of the number of deals being completed Q1 over Q4 compared to the total value. The largest M&A deals in the first quarter represented about 1/3 of total value. So you can see that still the most of capital is coming from larger funds. A slowdown in deal activity, just in terms of what it means for private equity, will inevitably lead to a further slowdown in fundraising, which again, as I mentioned on slide 2, we do view as a net positive trend. Instead of funds being put to work in less than 2 years, we're hopeful a slowdown in investment activity will really lead to GPs being more judicious and using their full investment periods of typically 4 to 5 years. This will provide some relief as well for LPs like LACERA that were facing very full fundraising calendars for the next 12 to 18 months, with some of those raises already pushed back to next year. Again, we're having to make incredibly hard decisions when it came to the sheer volume of managers back to market. So I feel like that will provide us some relief as fundraising gets pushed out. And then just in terms of the market commentary, I think the last point I wanted to make is that the recent volatility in public markets has definitely helped LACERA swiftly reach its target private equity allocation in the first few months of the year. Historically, private equity markets have lagged public markets, but smooth out over time and typically capture about 60% of the down. As mentioned, we expect further declines in kind of the second and third quarters, but do remain optimistic that the long-term nature of private investments will continue to serve LACERA well. And on that point, I think, we do think it is important to maintain consistent pacing year over year despite market volatility. And that's really just to capture, attractive vintage year performance, like we saw, coming out of prior recessions, and provide for a very consistent cash flow stream back to LACERA in the outer years. So maybe I'll just pause there on the market commentary, and see if there's any questions before turning it over to Dan.
I don't have and see any, so please continue.
Okay, great. And happy to entertain questions at the end as well. But maybe with that, turn it over to Dan to discuss LACERA's private equity performance.
Great. Thank you very much, Natalie. If you could flip to the next slide after this, please. Good morning, everyone on the committee and staff attending. I appreciate the opportunity to talk about LACERA's private equity performance, and also excited to kind of highlight the strong performance of the portfolio in 2021. This first slide is really a summary with a fair amount of definitions and numbers, so feel free to jump in with any questions. I'll try and hone in on a few of the more, I guess, telling metrics. But obviously this table is a comparison of the portfolio at year-end 2020 and then year-end 2021. And you can see on the right the changes year over year. So as it relates to the portfolio at year-end 2021, I would just note that the total exposure for the private equity portfolio is around 17 billion, and that's comprised of 12.5 billion of NAV or market value of existing investments, plus roughly 4.5 billion of unfunded commitments that will be substantially called down from investment managers over time. The next number I would call folks' attention to is the high-level performance of the portfolio since inception. So at 12/31/2021, the portfolio has generated a net multiple of 1.8 times and a net IRR of 16.7 times. Those are both increases year over year. On the IRR, it was roughly 40 basis points, and on the multiple, it was roughly 0.1x. What I would mention here is with the scale of the private equity portfolio, it is quite difficult to see significant performance changes on a year over year basis. So the fact that the multiple increased from 1.7x to 1.8x is actually quite notable. I think in most years you wouldn't necessarily see that large of a movement. I would equate it to kind of steering an ocean freight liner in terms of, seeing significant performance year over year in a portfolio this size. So I think that just speaks to the strong performance of the private equity portfolio in 2021. Another comment I would make on the year over year changes to the portfolio would just be some high level numbers, such as the market value of the portfolio increased by 3.4 billion. There were 3 billion of distributions coming back to LACERA. When you combine that with contributions in the year, there was roughly 500 million of net cash flow that came back to LACERA in the private equity portfolio. And there was a net increase of 12 active investments year over year. Next slide, please. This compares the private equity portfolio performance relative to the public market benchmark using a performance analysis method called the public market equivalent. So this essentially says, what is the alpha that has been generated by the private equity portfolio compared to the public market benchmark? In essence, if you had made contributions, if all of the contributions and distributions that occurred in the private equity portfolio were instead invested and realized at the same time in the public market benchmark, what would the performance have been? As you can see, the private equity portfolio performance as measured by net IRR has surpassed the public market implied PME in every period of measurement from 1 year to 10 year. This performance is obviously consistent and is significant across long time periods. And similar to the, the metaphor with the ocean liner, this is hard to accomplish, and I think it is quite a notable achievement of the portfolio over a long period of time.
Mr. Jones has a question.
Yeah, good morning. A question for you. So given that the last 10 years or so, we really haven't had, maybe with the exception of the financial crisis, we really haven't had a recessionary / inflationary environment. How will we expect private equity to compare against this benchmark in an environment that says, that has maybe 1 or 2 years of effects of inflation and perhaps lower than normal growth?
It's a good question. I think the short answer is I think over long periods of time, the performance of the private portfolio and the public benchmark will tend to compress. It's hard to sustain outperformance of this scale over an extended period of time. So I would expect it to compress, but I think the benefit is you're starting from a significant position of strength in terms of outperformance. So the private equity portfolio is a diversifying portfolio relative to the public markets. You do benefit from the ability to invest in private market assets at attractive valuations relative to the public markets. So it effectively it's an argument for continued allocation to the asset class, as evidenced by the strong performance relative to the public benchmark over time.
All right, thank you, Dan.
And I think that's significant, if I may. And I see Mr. Grable here as well. I mean, that was one of the mistakes that we made during the Great Recession, 2008, 9, and 10, in that we all panicked in 2008. I was on the board, and it was decided that we were going to stop investing in private equity, and it turned out to be one of the biggest mistakes that we ever made. One of the things that I'm proud to say, when we first went into lockdown in the US because of the pandemic, that the staff, Mr. Grable, and all of us on the board were dedicated and determined to continue to invest and deploy money in the private equity space. So lesson learned, I believe. I think I have Mr. Grable who would like to make a comment.
Thank you, Mr. Chair. Good morning, trustees. I think that that's a really important point, and Dan hit on it at the end. And I think later on this presentation, there might be a slide that shows LACERA's commitments going back to 1985, 86 by vintage year. And I think that what you tend to see, and I think it may be more true of other plans, is institutional investors tend to allocate a lot in bull markets and allocate a little in bear markets. And Natalie hit on that same point a bit when discussing currency. I think that the only way to answer the question from Trustee Jones is that we don't know. We know that it's going to be different. And I think that that's why we need to make sure that we construct our portfolio the right way, with the proper diversification, with the appropriate focus on different types of strategies. But we need to be consistent and not invest out of fear or greed.
Fears in particular. Thank you. Mr. Krikorian.
Great. Next slide, please. This is just another way to visualize the growth of the private portfolio since inception. So the gray bar is the 18 billion of total contributions since the inception of the program. You have a net gain of 15 billion on those investments, which equals 33 billion of total value. And as you can see, the total value is split between value that's been realized and value that is currently unrealized, or essentially the market value of the portfolio today. So the majority of the all of the contributions in effect have been realized. So net gain to the private equity portfolio. So this is just a helpful visualization over time since inception. The bottom of this page just calls out a few of the top performing investments over time. I would note that this is measured by net IRR and net multiple. So the performance of the investment, it is not weighted based on dollar gain. So you may have some smaller venture capital investments that, were home run investments that generated, for example, 188% net IRR, or on the right side, 32 times your money. Those are obviously not standard returns for venture capital, but that is how venture capital works with the power law distribution, where certain funds and investments generate the substantial value within the asset class. And so another reason to be long-term investors in asset classes like venture capital.
Right. And, one of the things that early on in my career here in LACERA, there was a lot of criticism of private equity. And in fact, I just read an article, I believe it was last week, Naked Capitalism. I don't know if you've seen it, where they criticized CalPERS, private equity program. And one of the criticisms that they raised was the fact that the valuations, right? So how you value your portfolio, your private equity portfolio, because you're relying, at least that's the argument that they were making, you're relying on the particular managers to value the underlying investments, portfolio companies. But the 12 billion to me, and I'd be interested to see how you react to my comment. To me, the 12 billion distribution that we have received is a reflection, a positive reflection of our managers' accuracy in the valuation of the respective portfolios. Do you understand my point?
Yes, I do. So yeah, it's actually 20+ billion of distributions, and the market value is 12.5 billion. I think the way to think about valuations is, obviously there are periods of speculation and frothiness where valuations perhaps get ahead of themselves within the venture capital space, and maybe technology and higher growth assets. I think there's general consensus that we've gone through a period of that in the last few years. But the benefit of the private markets is those investment managers are not forced to sell those investments when the time is not right. So I think the distributions were quite strong in the past few years. As Natalie mentioned, the IPO window was wide open. The IPO window has effectively closed. The valuations that high growth investments raised at in the past few years will need to come down. We're in a new valuation paradigm, but relative to the public markets, these private investment managers have funded these investments with a lot of cash that's sitting on their balance sheet. So there's good reason to believe they'll be able to weather the storm. And obviously the market moves in cycles, and there will always be an appetite for high growth assets in the public markets. So I think it's more around orienting yourselves to the timing of distributions. So we've had a strong period of distributions lately. That will likely slow in the coming quarters and years, but would expect there to be strong distributions as the economy kind of comes back in future years. Mr.
Great, thanks.
Santos, if I missed your question, please feel free to clarify.
No, I was just saying that the $20 billion, and thank you for the correction, in distributions that we have received is a counter argument to the critics of private equity that managers inflate the valuations, and therefore it's very difficult for investors like us to truly measure the value of the portfolio. But looking at the $20 billion distribution that we have received over the years, it's an indication of how it's not quite an indication, but at least it allows me to sleep well at night that the information in the past that we have received with regards to the valuation of the underlying portfolios that our managers have been relatively accurate given the distribution.
Absolutely, I would agree with that.
All right, great, thank you.
You can go to the next slide, please. This slide just illustrates the annual performance of the portfolio for investments of a specific vintage year. I think the takeaway here is similar to the earlier slide that showed the historical outperformance relative to the public benchmark. In this case, we're comparing to the private equity benchmark as measured by the median IRR of Burgess, which is a common, probably the most well-known private equity benchmarking database. And as you can see, in virtually every year, the private portfolios outperformed the benchmark. So the blue bars are the LACERA private equity portfolio, and the gray bars are just the median of the private benchmark. So very strong and consistent outperformance since inception.
I love this measurement because a lot of the critics against private equity think that we are crazy because we have a robust private equity program. But this is a perfect example of how important it is to continue to invest in private equity from my perspective.
Next slide, please. This just breaks down the portfolio by strategy and sub-strategy year over year. As you can see, pretty consistent on a strategy by strategy basis. I think any changes are minor and just signify strong performance within a specific asset class like venture capital and growth equity in 2021, but also increased investment activity in certain sub-strategies such as co-investments, which have been an active focus area for staff and the board, and then kind of natural decreases as fund to funds kind of tail off over time, and buyout, which is the largest segment of the portfolio, I think is just basically flat and only down 1%, probably just due to the strength of the performance of the other asset classes. Next slide, please. There's a lot of numbers on this page. I think it's good to reflect on the data. If you have time, we obviously don't need to get too deep into the weeds here. What I would call out is the far right column, the benchmark rank compared to the private equity benchmark. This first slide shows vintage years 1986 to 2007. Because LACERA has been active in private equity, we can't necessarily fit the entire, we can't fit every year on one slide, but The first, call it phase or era of the private equity portfolio, as you can see, really first and second quartile are the predominant rankings on a vintage year basis. So that means you're performing above the median in virtually every year. And if we flip to the next slide, this is obviously 2008 to 2021. We had to check that the data was actually accurate because of the consistency of the performance with every year, generating second quartile performance. It is accurate. And so I think that just speaks to the consistency of the performance. And, I think I'd also point out just the scale of the LACERA private equity portfolio. It is exceedingly difficult to achieve first quartile performance just because some of that alpha to really generate first quartile performance, is typically found with smaller managers, with smaller funds investing in smaller assets where, just by nature of LACERA's, the scale of their portfolio, it can be hard to, lock in a check size in a small fund that really moves the needle for LACERA. So second quartile performance, I think should be viewed very positively, and just first quartile performance is very hard to achieve with a program size the scale of LACERA's.
No, I agree. I mean, I wondered what funds bigger than us deal with it, because like CalPERS, I believe the dollar amount per deal has to be $500 million. We struggled to deploy $150 million per deal. Let's see, I have another question here. Mr. Knox.
Thank you, Chair Santos. Was there somebody else?
No.
Oh,
Yeah.
yeah, maybe this question is for Mr. Grable, and I don't want to steer too far off topic, but I was reading, I think over the weekend, about CalPERS selling $6 billion in private equity stakes, and maybe some of that is reflective of a new CIO, and I was reading how they seem to have varying levels of interest in staffing positions dedicated to private equity over the years. I guess the question for you is, in line with Mr. Santos, making sure we lend the right amount of emphasis and support to this program. How do you view what CalPERS did? How do you kind of bring to light things that allow us to best support this program, to understand ebbs and flows, et cetera?
Thank you, Mr. Knox, for the question.
Super vague question at 8:45 in the morning.
Yes, no, I'll answer it several ways. The first is, it's great that CalPERS is following us in that we did a large secondary sale, I believe in 2018. So, 4 or 5 years ago. And I think that, I don't mean that in a kind of cheeky way. I think that for many fund commitments, the best is already realized. So to hold on to investments that are 10 plus years old and hope that you're going to get a stellar performance out of it, I think that that's hard to do. So my sense is, and I don't want to opine on what CalPERS did, but what went through our collective mind in 2018 was that we have a great private equity program. We have great processes, as evident by the consistency in the returns. And I think something that's masked in this slide is, if we're second quartile every single year, over time, we're probably first quartile. So I think that the individual years may be a false measure. But I think that we have continued to evolve our program, which may be the second part of the answer. A long answer to the question is, if I think about our program, it's really 3 aspects that feed on one another. It's direct fund investments, it's emerging managers, and it's co-investments and secondaries. And all three, play on one another to optimize outcomes for LACERA and our members. And I think that maybe, not that we're ahead of our peers, but we're ahead of our peers in the sense that we like to have a more dynamic program, and one that's not just predicated saying, yeah, we're going to pick great managers and hope it works. We're trying to have a program with a thoughtful structure, thinking about stage, thinking about geography, thinking about form of investment. And I think that's what that allows us to stay atop over time of our private equity program. And a big shout out to the team for having a really good process.
Yeah, kudos to the team. That's evident. Thank you.
Totally. But joining that comment, Mr. Krikorian, we have about 10 minutes, so just heads up.
Okay, great. Thank you. I will keep my commentary brief, but again, don't hesitate if there are any questions. Next slide, please. This just outlines the performance by strategy. I think a few things to point out. Venture capital has been a significant outperformer at a 2.4x multiple and over 21% IRR. I think you can attribute that to the long-term commitment to the asset class and LACERA's legacy investments with some very high quality venture capital managers in the 1990s, early 2000s, as well as the early outperformance of relatively recent commitments to venture capital in the last 3 to 5 years. Growth equity might also jump off the page with an 87% net IRR. I think that's driven by a few outlier investments that were made earlier in the program's history that performed exceptionally well. So I think over time would expect that that category performance to come down. It's obviously quite strong, but no one expects any asset class to consistently generate 86% IRRs, but just speaks to some of the strong manager selection earlier in the program's history. In the interest of time, why don't we go to the next slide? This pie chart details.
Mr. Krikorian, can you give me a second? Ms. Jones, good morning. She has a question.
Good morning. I just wanted to make sure I understood, because you mentioned it in the beginning of the slide, the unfunded of $4 billion. What exactly is that?
Yes, thank you for the question. That is commitments that have been made to funds that the manager has yet to call capital for. So that's the natural way that fund investments work, is you commit to invest a certain dollar amount, and then as the investment managers identify investments, they will call that capital from the limited partners. So that is effectively a liability capital that you would expect to be invested in investments in the coming years.
Gotcha. All right. Thank you.
Absolutely. On manager diversification, you can see here that the top 10 investment managers in the LACERA private equity portfolio represent roughly 43% of the net asset value and the unfunded. And so naturally 57% of that would be to the remaining investment managers. Given LACERA's average commitment size, the top 10 managers skew towards buyout strategies, and most of these are large market buyout investors. Also, many of which are long-term relationships where LACERA has invested in multiple of the funds. So this doesn't imply that this reflects one fund commitment. In some cases, this could reflect LACERA investing in 3 4 or 5 of a firm's funds, given strong performance historically. Next slide, please. I believe this is the last slide. This just is a visual representation of the cash flow of the private equity portfolio. So the blue bars are contributions, meaning investments, capital going into investments, and the gray bars are distributions, meaning investments being sold and cash coming back to LACERA. If you total up the last 5 years, so from 2017 to 2021, the cash flow activity is roughly flat. It's nearly 8 billion of contributions and also 8 billion of distributions. And if you look at 2021, I think this also signifies some of the commentary that Natalie had earlier on the market, was just the strong activity both in new investments and in investments being sold and cash coming back to LACERA in 2021. So, the contributions and the distributions were both large and kind of, compared to prior years were I guess the largest in the last 10 years of the program. That wraps it up. I wish I had a final slide with conclusions, but I think hopefully that summarizes the performance. But happy to take any final questions at this point.
Yes, thank you. We have about 4 minutes, and I was just wondering if briefly you can take us around the world and the possibilities there. Let's start with Africa, Latin America, Asia, and Europe. What opportunities are there? The emerging markets, large market like India. Could you give us a brief commentary on that, please?
Yeah, I can kick it off, and Dan, feel free to jump in. I mean, I think we continue to believe that attractive opportunities in emerging markets exist. It includes some of those economies that you mentioned, Mr. Santos. It includes economies within Latin America, Asia, as well as Africa. The challenge historically has been the number of managers in those economies, but of course, the numbers are not going to grow until the capital comes. So remain kind of committed with offices in each of those geographies to kind of turfing up the best opportunities. There's pockets within, different strategies. So buyout, venture, growth equity, and special situations in each of those markets. And depending on kind of the macro climate, some of those attractive strategies become in or out of favor. I would, call out particularly in Latin America, there's been kind of a prevalence of kind of venture capital and growth equity managers that have popped up in kind of the most recent 5-year period, which we think is pretty attractive and can lead to some attractive growth opportunities within that market. Similarly, out of Asia, China, South Korea specifically, there's been attractive kind of growth equity and venture opportunities, specifically within tech investments. And then I think in Africa, we see opportunities in Africa and India, specifically around kind of infrastructure, more like buyout investments within those economies, just kind of basic services that are critical to the growth of those economies. So continue to think that opportunities exist in each of those markets, continue to think that, in terms of building a well-rounded portfolio, you need to have exposure to each. It's just kind of when the right opportunities come up based on fundraising cycles and the number of opportunities that exist in each market is a little bit different.
Great, thank you. And so when we talk about Africa, you're talking about Sub-Saharan countries in Africa?
That's right.
Good. I think Mr. Knox also has a question or comment.
No, I'm good.
Oh, that's right. Okay. Thank you. Thank you very much. Okay, so this pretty much concludes the private equity presentation, performance presentation. Next item is good of the order. Anyone has any burning desire to say something? If yes, speak up.
Good meeting, good presentation.
Thank you, sir. Thank you, Ms. Walker, Mr. Krikorian. Just, I'm a believer in private equity, and I just want to say something really quick. When I first got elected to the board, I came in with a mandate from a lot of my constituents that we needed to eliminate private equity. And private equity was like going to Las Vegas in sitting at one of those tables. And I made it my purpose to learn as much as I could about private equity. And I was able to, years later, obviously, I was able to go back to those organizations who had pretty much charged me with eliminating private equity in LACERA and begin to argue. And I used some of the benchmarks, like the comparison between the public markets and the performance in private equity. And they could not argue or convince me that we needed to get rid of private equity, and I'm more convinced as we have seen over the years the performance of this program. And that's why Mr. Kryman, I don't see you up there, and always pushing on making sure that the investment staff are fully staffed because of these situations that we have here. We need to continue to perform at the highest level that we have been performing over the years. So it's not that I'm being a pain in the rear. It's just that I really believe that this is that we have a very good thing going here with our investment program in LACERA, and I want to make sure that we continue to do that. Anyway, with that, I will entertain a motion to adjourn this committee meeting, and we will roll in about 2 minutes for the Board of Investments.
Mr. Santos, let's start the Board of Investment meeting at 9:05.
9:05 it is, but I need a motion to adjourn.
So moved.
Thank
Second.
you.
Bye.
See you in 9:05. Thank you.